Sam Bankman-Fried's conviction is all over the news. Like everybody else, I've been watching this grand tragedy with amazement. But I hope this video will touch on a few things you might not hear elsewhere. Lots of people have asked me exactly what he did wrong. The short answer is he committed one of the biggest financial frauds in history. But many people who ask me that question struggle to distinguish between legitimate financial services and financial fraud. Also, some think they can't understand what he did because they don't understand cryptocurrency. As to the first, I'm here to explain the difference. As to the second, crypto and the technology underlying crypto has nothing to do with it. But if you want to learn more about crypto and blockchain, I wrote a series of basic articles on the topic that you might find interesting, and I'll link to those in the description.
Heather thinks about software.
So here's the difference between legitimate financial services and financial fraud. Legitimate financial services like banks accept deposits and lend money out. Think about the Bailey brothers building a loan in It's a Wonderful Life. Now, if a bank takes your money and lends it to someone for a long time, like in a mortgage, and you ask for your money back, they can't give it to you, right? Well, not exactly. Banks have to follow extremely strict regulations, including how much of their assets they can lend out at any one time and what kind of investments they can make. Banks are mostly limited to making conventional loans and not investing in stocks or other more volatile investments. So your bank should have good visibility into its cash flow from its loans and its depositors' demands for cash. Under normal circumstances, it will be able to repay your deposits on demand, unless there's a black swan event and all the depositors ask for their money back at the same time. That's called a run on the bank. As a quid pro quo for playing by the rules, banks are insured by the FDIC. So if there's a run on the bank, like there was with Silicon Valley Bank earlier this year, the FDIC gives depositors their money back up to a certain point. Banks following their regulations is why the FDIC can remain in business. Like any insurer, they can only stay in business if the risk is spread out and therefore predictable. It's just like insurance for your car. If you're a good driver, you might get into an accident, but the chances are low. But it's unlikely that lots of drivers will get into accidents simultaneously. So your insurer can afford to pay out your claim. Now let's talk about hedge funds. A hedge fund is an investment fund. They take money from their investors and try to invest it in more speculative investments for high returns. Those investors know they could lose their money, but they're willing to take the risk because they can afford it. Hedge funds only use money from wealthy investors with minimum net worth or investment experience. These are called qualified or accredited investors. So how does all this relate to FTX, Bankman-Fried's company? FTX was neither a bank nor a hedge fund. It was an exchange. People who gave deposits to FTX were not expecting FTX to invest them, much less fritter them away on sponsoring sports teams, buying mansions, bribing Chinese officials, celebrity endorsements, and donating to politicians and political causes, including pet causes of SBF's mother. Think of this like what happens when you go to a casino. Cryptocurrency is a lot like a casino chip. Instead of a physical token, it's a digital token. You give the casino $100 and it gives you chips. If you want to gamble, you can only gamble with chips, not cash, so you have to deposit money with the casino in order to play. But you know that, win or lose, the casino will honor your chips by cashing them in. You don't expect the casino to invest them and then tell you, sorry, we lost that money investing in tulip bulbs. Now, lots of customers of FTX were speculative investors who made gambles of their own using the tokens they bought on the FTX exchange. Maybe those bets were smart or foolish, that's their own concern. But when FTX used their funds to make its own highly speculative investments, it committed fraud. Unlike a bank, FTX was not regulated in a way that protected its customers. Now, that doesn't mean it had the right to do whatever it wanted to do with its customers' money. If it were going to invest its customers' money, it had to warn customers about that. Then it would be more like a hedge fund, and it would have to play by the hedge fund rules. Customers thought they were buying casino chips, but they were really buying into a black box of investments with only a downside and no upside. FTX's sister company, Alameda Research, was a hedge fund. Part of the fraud was that FTX allowed Alameda to use FTX customer deposits for its investments. Alameda made more and more speculative crypto investments until now, needless to say, that money is gone. So you see, if you give deposit money to a bank, the bank can invest it, but it has to play by the rules. Even the recent bank failures like Silicon Valley Bank were investing within the rules, just not wisely. FTX wanted to have its cake and eat it too, taking deposits, avoiding regulations, and not being honest about what it was doing with deposit money. Before I end, I'll explain a couple of additional things about SBF and his trial. First, it's not over yet. SBF will almost certainly appeal, probably claiming that he had insufficient access to Adderall and vegan food during the trial and whatever else his defense team can dream up. But win or lose, he is vulnerable to other legal action, possibly state criminal charges from other nations, and civil claims. This trial was only the federal trial for financial fraud. And SBF's parents, Bankman and Fried, are not off the hook either. They were allegedly complicit in his actions, as shown in the case against them by the FTX bankruptcy estate. Don't get me started about that. They're Stanford professors, one of whom is an expert on legal ethics. SBF's cohort at FTX will also be sentenced, but they made plea deals to testify against him, so their penalties will likely be light. Also, while the crimes SBF was convicted of bear jail time of up to a total of 110 years, his sentencing still remains. In the U.S. federal system, judges are required to abide by sentencing guidelines. Application of these guidelines is complicated. Sentences can be enhanced based on a point system that turns on various factors. The prosecution and defense will doubtless argue about how the guidelines should apply. Enhancements can include the number of victims, amount of the loss, sophisticated means, and prior criminal record. A federal judge has some leeway, for example, to order sentences for all the counts to be served concurrently or serially. That makes a big difference. The amount under subsection 2B 1.1b1a of the guidelines for fraud only goes up to $550 million. So basically, SBF's fraud is more than the guidelines ever anticipated possible. That means the judge might make an exception and try to go above the guidelines. SBF's prospects are dire indeed. I'll link to an article in the description about how the guidelines might be applied to him. Also, there is no parole in the federal system, although inmates can earn what is called good time credit. And as a result, federal prisoners tend to serve about 85% of their sentences. So by the time SBF gets out of prison, he will be a lot older and with luck wiser. But if he is convicted of additional crimes, he may be bouncing from one jail to another for a while. Thanks for listening. Liking and subscribing makes me think more.
Heather thinks about software.